Welcome to the Deep Dive. Today we're jumping right in, looking at this massive shift happening in the car world, the electric vehicle revolution. But it's more than just cleaner cars, isn't it? It's become this high-stakes battle, especially playing out right now over in Europe. Just think about this. The EV market in Europe, well, it's booming this year. Battery electric vehicles, BEVs, they're up a huge 31% compared to last year. And plug-in hybrids, the PHEVs, also surging, up 31.5%. So, overall car sales will look pretty healthy. And this isn't just happening by chance. It's really driven by the EU's big goals, like carbon neutrality by 2050, banning new combustion engine cars by 2035. Plus, you've got subsidies, tax credits pushing things along. So the big question for us today is who's actually grabbing all this growth? And, well, why?
Yeah, and what makes it really fascinating is that this growing market is also becoming a real strategic economic battlefield. We're already seeing talk and action on rising tariffs for Chinese EV imports into Europe. So it's not just about selling cars anymore. It's about protecting local jobs, local industries, and really shaping who controls manufacturing in the future. It's like a global chess match almost.
Absolutely. And for so long, when you thought EVs, you thought Tesla, right? They were the poster child, the innovator everyone was watching. But here's the twist, and it's the surprising one. As market leader, they seem to be hitting some, serious turbulence in Europe. What's going on there? The numbers, they really tell a story. Tesla's European market share has actually dropped. It was 3.4% in 2024, now down to 2.8% by mid-2025. And we're not talking a small dip. Look at July 2025. Some key markets saw sales just collapse. France, down 27%. Germany, wow, down 55%. The UK, down 60%. Sweden, an incredible minus 86%. Netherlands, 62% down. Belgium, 58% down. Portugal, 49% down. Just huge drops. There were a couple of bright spots. Norway up 83%. Spain up 27%. But reports suggest those were mostly linked to specific incentives. So here's the paradox, right? The overall EV market in Europe is growing fast, but Tesla is actually shrinking within it. I find that just fascinating.
It really does show how fast things can change. And Tesla, they're facing headwinds from multiple directions, you could say. First off, let's talk product. Their refreshed Model Y, which came out in March 2025, it seems to have pretty much flopped. Registrations just cratered in places like Sweden. You mentioned the 86% drop. I think Model Y specifically was down 88% there. And this really highlights a weakness for Tesla. Their limited product range, they just don't have the variety that competitors like, say, BYD, VW, Renault, or Hyundai are bringing to the table now.
So it wasn't just that the refresh missed the mark, it's that they lack other models, other segments to kind of cushion that blow.
Exactly. Relying so heavily on just a couple of core models makes them really vulnerable if one stumbles or if the market just wants something different. Second thing is pricing pressure, serious pressure. Tesla's had to slash prices quite aggressively. We saw it in France, right? Even with big discounts, their market share still slid from 1.6% down to only 0.9%. And these heavy discounts, they obviously hit margins, but maybe more importantly, they risk damaging that premium brand image they built. Constant sales can dilute that exclusivity feel.
Right. And I've heard whispers, more than whispers, about some reputational issues too, especially around the CEO. Is that factoring into these numbers?
Oh, absolutely. But it seems to be playing a role. Beyond the product and pricing, Tesla is dealing with significant regulatory and reputation challenges in Europe. The EU has really strict rules, and they severely limit Tesla's full self-driving features, FSD. That's a big selling point elsewhere, but here, not so much value. Then you have Elon Musk's public statements, particularly some far-right endorsements he made in Germany. That sparked actual protests. And it seems linked to that huge 57.8% year-to-date sales drop in Germany. Plus, their, let's say, stance against unions doesn't sit well with Europe's strong labor traditions. So you put it all together. Weak product refresh, losing pricing power, regulatory roadblocks, and definite brand damage. It's a bit of a perfect storm for them right now.
That is quite the turnaround from just a couple of years back. Okay, so while Tesla's stumbling, there's this other player, BYD, who isn't just emerging, they're like sprinting ahead. Let's pivot to them because their story in Europe is, the complete opposite of Tesla's right now. They're surging and the numbers are just as stark, but going the other way. Get this, January to May 2025, BYD sales in Europe were up 146% year over year. Just phenomenal growth. And look at July 2025 again. Spain, their sales were up 8 times, 8-fold increase. The UK, 4 times the registrations. And Germany, where Tesla's really hurting, BYD saw an incredible, almost unbelievable 390% year-over-year growth. And the crucial point here, BYD actually overtook Tesla in overall European EV sales volume back in April 2025. That's a massive shift.
It really is. And BYD's success isn't accidental. It's built on a very deliberate and pretty effective strategy. They're really hitting that affordable mass market segment hard. Think cars like the Dolphin, which is known as the Seagull in other markets. It's a cheap, practical EV for city driving. But they also have models like the Seal U, a plug-in hybrid, which actually became Europe's top-selling PHEV in June 2025. So that shows their variety, right? They offer both pure electrics and hybrids across different price points. It's a clear value-for-money message, and it seems to be hitting home with European buyers.
So it's not just being the cheapest, it's about having the right options at good prices for different kinds of buyers.
Exactly. They seem to understand the diversity within the European market quite well. And then there's the expansion piece. They're moving incredibly fast. They're planning to enter 12 more European countries just by the end of this year, 2025. And a really key strategic move is building that new factory in Hungary. That's huge.
Oh, local production.
Right. It helps them reduce costs, potentially get around some of those tariffs we mentioned earlier, and it boosts their image, their credibility within the EU, becoming a local manufacturer. Plus, they're rapidly building out their dealership network across the continent. You see their signs popping up more and more. And this is all part of a bigger picture, this wider Chinese EV surge. Chinese brands as a whole doubled their market share in Europe, from about 2.7% in 2024 to 5.1% in just the first half of 2025. And BYD is definitely leading that charge. So yeah, bottom line, BYD is winning on price, on product diversity, and just sheer aggressive expansion.
Wow. Okay, so that European surge is impressive, but it's part of an even bigger global story for BYD. Let's just zoom out for a second. They didn't just appear overnight. They started way back in 1995 making batteries. Then they moved into cars around 2003 and EVs specifically in 2009. And something pretty significant is the backing they've had from Warren Buffett's Berkshire Hathaway. They've owned a stake around 4.4%, I think, since way back in 2008. That gives them a lot of credibility, and their growth just between 2020 and 2024, it's been, well, explosive. Annual sales went up 10 times, tenfold, from about 427,000 cars to 4.27 million. Revenue quintupled in that time. Net income also grew tenfold. And crucially, they overtook Tesla as the world's biggest EV maker by volume in the 2023-2024 period. So what's underpinning all this? What gives them this edge, this momentum that seems so strong right now?
Right. So this is where we talk about BYD's competitive moats. Those fundamental advantages that are really hard for competitors, including Tesla, to match quickly. The biggest one is probably their vertical integration. BYD makes its own batteries, its own electric motors, even its own semiconductors, the chips. Now, that's not just about saving money, though, does that. It's a massive strategic advantage. It gives them incredible control over their supply chain.
So they're not waiting on suppliers if there's a shortage or paying markups.
Exactly. They can innovate faster, adapt to market changes quicker, and they're just more resilient to global disruptions. It's a huge plus. Then, building on that, they have a real edge in battery technology with their Blade battery. It's an LFP type lithium iron phosphate. And the key things there are, it's considered safer, it's cheaper to produce, and it generally has a longer lifespan than the typical lithium-ion batteries most others use. Safety and cost, big factors for EVs. They also have this thing called the E-Platform 3.0. It's basically a modular base for their cars, which means they can develop and manufacture new models faster and cheaper. Helps them roll out that variety we talked about. And finally, having that mix of pure EVs, the BEVs, and the plug-in hybrids, PHEVs, gives them flexibility. Not every market has great charging everywhere, so offering hybrids is smart. They cover more bases. And you see this reflected in forecasts. JP Morgan, for instance, expects BYD sales to hit 5.5 million units in 2025, then maybe 6.5 million in 2026. The general analyst view, the consensus, is for something like a 19% average annual growth in revenue, and that's the CAGR, and maybe 25% growth in net income each year between 2024 and 2027. That's very strong growth. So yeah, BYD isn't just a Chinese company anymore. It's scaling up globally, and it seems to have these fundamental manufacturing advantages that Tesla currently struggles to match.
Okay, so that naturally leads us to the investment side of things. What does all this mean if you're looking at BYD from an investment perspective? Just looking at valuation quickly. BYD is trading at less than 1 times its annual sales and around 17 times its earnings. Now, that seems relatively inexpensive, doesn't it, for a company showing that kind of double-digit growth, especially when you compare it to Tesla, which trades at much, much higher multiples despite, well, weaker recent growth. So what are the key takeaways for an investor here?
Well, looking at the strengths, BYD certainly presents a compelling case. You've got the market leadership in terms of EV volume. You've got that cost edge from vertical integration we discussed. There's the aggressive expansion happening right now, particularly in Europe, but also other regions. The diverse product range is a big plus compared to Tesla's narrower focus. You have that strong projected growth trajectory, those KGRs we mentioned. And as you pointed out, the backing from Berkshire Hathaway does add a certain layer of investor confidence.
Okay, that sounds like a solid foundation. But, every investment has risks, especially in such a dynamic industry. What are the potential downsides? What should people be cautious about?
You're absolutely right to ask. It's crucial to look at the risks, too. A big one is the heavy reliance on the Chinese market. That makes them vulnerable to, well, politics, tariffs, trade wars, shifts in domestic policy. That's a significant uncertainty. Then there's the risk of price wars intensifying. As more players pile into the EV space, competition could get brutal, and that could really squeeze profit margins for everyone, including BYD. They also face very real competition from the established European automakers, VW, Renault, Stellantis. They're pouring billions into EVs and have strong brands and distribution networks in their home turf. They won't give up market share easily. And lastly, all that expansion, building factories, R&D, it costs a lot of money. High capital expenditure can be a drag on near-term finances, even if it's for long-term growth. So yes, definitely risks to consider.
Definitely. And that's why looking at potential future scenarios can be helpful, right? We can try to model out what BYD's financials might look like over, say, the next 5 years based on different assumptions. Let's assume for these scenarios that BYD keeps its momentum going in Europe, China stays relatively stable for them, competition is there but manageable, and we don't get like an extreme trade war shock. Okay, so first, a base case. Let's say sales grow at a solid but not spectacular 15% compound annual growth rate, the KGR. In that case, revenue could roughly double from today's $115 billion or so to maybe around $230 billion by 2029. Net income might go from about $6.3 billion now to maybe $12 billion. That translates to earnings per share, EPS, around 60. Now, if the market keeps valuing them similarly to now, say a price to earnings ratio, PE, of 17 to 20 times, the stock price could potentially double, maybe 2.5 times higher in 5 years. This would make BYD what you might call a solid compounder. Not necessarily explosive returns, but steady, strong growth from a market leader. Okay, now let's look at a more optimistic bull case.
Let's assume they really nail the execution and sales grow faster, maybe 22% CAGR. This scenario assumes their European expansion is a huge success. Maybe they grab 10-12% market share there. It assumes models like the Seagull Dolphin really take off globally. It also assumes EV subsidies remain generous, and maybe Tesla and the legacy guys continue to struggle a bit in Europe. Under these conditions, revenue could potentially hit $300 billion by 2029. Net income could be around $18 billion, pushing EPS over 90. Now, if investors start seeing BYD as the dominant force and re-rate the stock, maybe give it a PE closer to what Tesla sometimes gets, say 30-35 times earnings, well then the stock could potentially see a 4 or even 5-fold increase over 5 years. This is the scenario where BYD truly becomes a global EV giant, perhaps even the new Tesla in terms of market perception. But of course, we have to be balanced. Let's consider a bear case. What if growth slows down significantly, maybe only 5-8% CAGR? This could happen if trade wars really escalate, leading to very high EU tariffs, maybe 30-40% or more, on Chinese EVs.
Or perhaps BYD struggles to win over European consumers. Maybe the brand perception remains stuck as just cheap Chinese import. What if price wars get really bad and crush margins? Or maybe China's economy slows down hard, hitting their huge domestic market. In this scenario, revenue might only reach, say, $150 billion by 2029. Net income could flatten out, maybe around $7 billion, leading to an EPS of only about 30. If that happens, there might be very little upside for the stock over 5 years. It could even mean a potential downside, maybe 30-40% lower than today.
So just to kind of wrap up the core contrast we've discussed today, Tesla in Europe. Clearly facing challenges, shrink in market share. It seems to be a mix of product issues, pricing pressure, regulatory limits, and some brand image problems. BYD in Europe, on the other hand, is absolutely surging. We're seeing explosive growth driven by models that hit that value for money sweet spot, plus really aggressive network expansion and that underlying cost advantage. And crucially, they've already passed Tesla in European sales volume. Globally, the picture reinforces this. BYD overtook Tesla in total sales volume last year and seems positioned for continued large-scale growth.
Yeah, I kind of find myself thinking of an analogy, maybe it helps. Think of Tesla as maybe like Apple Premium, very sleek design, iconic, commands loyalty. But at least in Europe right now, people seem to be asking, is it really worth the premium price? Especially with strong alternatives emerging. Now think of BYD, maybe more like Samsung. They offer a huge range, from affordable basics right up to higher-end stuff. They focus on delivering good value across the board, and they're just pushing aggressively into every possible market segment. And in a market that's growing as fast as EVs, sometimes that Samsung-style flexibility and breadth can be more powerful, at least for capturing volume, than the Apple-style exclusivity.
That's a pretty good analogy. And for listeners interested in this from an investment angle, BYD certainly looks like a strong contender, potentially a long-term winner in this EV race, particularly when you look at its valuation compared to its growth prospects. Now, the risks we talked about, the China dependency, potential tariffs, price competition, they are absolutely real and need to be considered seriously. But the overall momentum, especially in the key European battleground, currently seems to favor BYD over Tesla. It positions BYD as one of the most significant EV investment stories out there today.
It's definitely more than just a story about two car companies, isn't it? It's a really fascinating snapshot of how global industries can shift and the power of having a diversified strategy that really focuses on value. It leaves you thinking, when a big technological revolution happens, sometimes it's not the company that was first or maybe the flashiest, but the one that proves most adaptable and offers the most comprehensive value proposition that ultimately reshapes the landscape. Something to chew on. And finally, just a reminder for everyone listening, please remember we are not certified financial advisors, and this deep dive is purely for educational purposes only. If you are considering making any investment decisions, please make sure you consult with a certified financial advisor first.